With a new year comes new resolutions and new inspirations for investment. For that reason, veteran investor Warren Buffett shared his valuable views on how you should invest in 2023. According to him, 2023 can be a life-changing year for most investors. But why does he think so? What pieces of advice did he share for investment in 2023? Let's have a look. As Mr. Buffett indicated, a negative liquidity impulse and growth shock for global risk assets, which were on a high from a cocktail of near zero rates and money printing as we entered 2023, have been the result of the triple whammy of high inflation, balance sheet tapering by the US Fed, and the rise in Omicron cases across Europe and North America. Global risk assets have seen some correction as a result, with emerging markets taking the worst hit. Large oversubscribed IPOs at home and persistent selling by foreign portfolio investors drained liquidity from Indian shares and caused the BSE Sensex to decline by double digits. The 10-year Treasury yield on Indian bonds has risen to 6.45%, the highest level since April 2020, while the Indian rupee has depreciated against the dollar and is approaching its all-time lows of April 2020. What will be the market's driving force in 2023? Risk is something no one anticipates. Nobody saw the IL and FS fail in 2018, the COVID-19 default in 2020, the taper tantrums in 2013, the demonetization in 2016, or the Lehman collapse in 2008. However, depending on how complacent they are, different risk occurrences have different effects on the market. Values are a good indicator of complacency. Even if risk occurrences are hard to forecast, it pays to be aware of the major variables or levers that might have an immediate influence on markets. Such elements include stagflation and the second taper tantrum. For any leadership, stagflation is political suicide. Sharp price increases and declining or stagnant earnings are the two factors that unify people the most. They have incited several significant regime transitions or large-scale uprisings throughout history. An excellent illustration is our personal experience with expensive onions. Likely, we're currently experiencing stagflation. Factory production and consumption have already been hampered by shortages of electricity and other essential inputs combined with COVID lockdowns in Europe and China. The majority of the expansion in corporate top lines after COVID has often been brought about by price increases alone, since sales volumes remain unchanged. What functions in stagflation? Is it only gold? This time, the solution may not be as simple. The only sector of commodities that hasn't kept up is precious metals. Despite rising inflation and many waves of COVID variations, gold has underperformed over the last 17 months, raising questions about its suitability as a solid inflation hedge in the age of the cryptocurrency frenzy. And it could not be good news for gold if central banks tighten policy and real interest rates rise. What will 2023 look like? Most asset classes, including stocks, bonds, and cash, should be impacted by a combination of high inflation, poor growth, a third COVID wave, and tighter monetary policy, with the possible exception of residential real estate and gold. Real rate increases might reduce demand for gold as well. It's possible that returns won't be as frequent as they've been during the last 18 to 20 months. After an unbroken bull run of 18 months, we are now coming to an end. If the growth rate is to be sustained moving ahead, a boost in demand is essential. Otherwise, valuation multiples may degrade. Therefore, a balanced market cap agnostic strategy may be more effective in 2022. Markets may see periods of turbulence as they deal with 2.0 taper tantrums and concerns of a third COVID wave. The two main risks to this prediction are a considerably weaker than anticipated Omicron wave in India and a U-turn on tapering from the US Fed. What actions should traders take in 2023? It's time to monitor your asset allocation and rebalance your portfolios. By moving a significant portion of the equity exposure to dynamic asset allocation funds, a current investor with a long-term vision may lower risk in the portfolio, also known as balanced advantage funds. By just assuring that the upside capture of stock returns is greater than the downside capture, these funds have a demonstrated track record of producing equity-like returns at approximately half the risk over medium to long periods. The nicest thing about them is that they don't depend on people's opinions or feelings to decide how to allocate assets. A restricted allocation to developed market shares, mostly American ones, is another strategy that might be successful in 2022. Consider investing in diversified equity funds that have a 25 to 30% exposure to U.S. stocks. Opportunities still exist in some areas. Savings and investors in non-market linked fixed income instruments may have cause to be pleased when yields increase as the yield curve flattens. Industries, utilities, and infrastructure are cyclical industries that have seen high profit growth and increasing investor interest. However, since they will be more susceptible to market-to-market losses if rates increase, investors in market-linked debt instruments need to exercise more caution. Investors may turn to tangible assets like gold and real estate when there's high inflation. Gold has typically performed well during stagflationary times and thrives in unpredictably changing conditions. It's a strong hedge against a declining native currency and has a low connection to stocks. Although these traits or connections may have been unproductive in recent months, they have the potential to become more beneficial in the future. So what do you learn from these? Post your comments in the space provided below. Thank you for watching.